Chasing a 6.30% yield across the causeway might feel like an undeniable win for your portfolio, until you sit down and realize it completely ignores the 2.6% annual currency drag quietly eating your retirement. For the heartland investor planning their future, the stakes are not about theoretical returns on a screen. They are about preserving your future purchasing power in Singapore dollars. Today, we run the 5-layer forensic audit on why the CPF 4% floor consistently beats the EPF illusion when the math is stripped of emotion. Every major trade corridor in Southeast Asia eventually forces a choice between the speed of growth and the security of the vault. For decades, the Johor-Singapore Causeway has served as the physical manifestation of this tension, a strip of asphalt where capital, labor, and retirement dreams flow in opposite directions. On the northern end, the Employees Provident Fund has long stood as a regional powerhouse. When it recently declared a 6.30% dividend for the 2024 financial year, Singapore looked on with a mix of envy and confusion. It sets the stage for a critical forensic showdown between two very different retirement engines. When that 6.30% figure arrives from Kuala Lumpur, it creates a psychological ripple reaching all the way to the HDB blocks of Bedok and the coffee shops of Jurong East. The consensus narrative that quickly forms is that Singaporeans are somehow stuck in a low-yield trap. We look at our CPF accounts and feel tethered to a 4% floor, while our neighbors seem to capture the upside of a more aggressive investment mandate. But yielding to that envy without looking at the underlying math is exactly how retail investors walk blindly into a wealth-destroying trap. The forensic gap here lies in the structural architecture of these two engines. On one side, you have a fund that operates like a global asset manager, chasing tech alpha and private equity gains to satisfy a domestic demand for high nominal returns. On the other side is the CPF, built as a sanctuary model that prioritizes the preservation of your purchasing power in a fortress currency. They are fundamentally different vehicles designed for different economic climates, and treating them as a simple side-by-side yield comparison ignores the invisible tax of currency volatility. For the Singaporean investor managing a CPF or SRS portfolio, especially someone approaching age 55 in Queenstown, the real storm is not a lack of yield. It is the potential for a total miscalculation of what a real return actually looks like in a decade defined by regional currency shifts. The stakes are not theoretical for your wallet. They are calculated in the critical difference between a retirement spent in a stable sanctuary and one spent chasing a vanishing yield across a shifting border. If you get this wrong, you risk running out of capital at the worst possible time. Let me share my personal insight here. The psychological gap is massive because institutional money treats this corridor as a sophisticated carry trade, looking at the real effective exchange rate and sovereign credit backing. But the average retail investor, they are only looking at the declared dividend percentage on a mobile app. The EPF headline acts as a dividend trap for those who fail to account for the higher risk tilt. Envy is not an investment strategy, and a 6.30% yield in a weakening currency is often just a slow-motion liquidation of your future purchasing power. The reality of this regional yield gap hits the kitchen table the moment you look at the cost of living trajectory in a fortress economy like Singapore. For a household in Toa Payoh or Woodlands, the 4% special account floor is not just a number in a ledger. It is a legislated, guaranteed hedge against the relentless creep of imported inflation. When Singapore's core inflation sits at 1.6%, your 4% yield represents a real gain of 2.4 percentage points annually. Meanwhile, a Malaysian retiree faces a cumulative currency loss of 29% against the Singapore dollar over the last decade. For the investor managing SRS funds, the calculus is extremely direct. The EPF's heavy tilt into global tech, healthcare, and private equity makes it effectively a high-conviction equity fund. If you are a 55-year-old in Singapore, do you really want your retirement sanctuary exposed to Nasdaq-level volatility? You cannot spend a nominal percentage at the supermarket. You can only spend the value that remains after the currency market has taken its cut. When the market turns, that exposure can devastate a portfolio. This regional dynamic is already repricing how forensic investors look at SGX sectors, particularly local banks and top-tier REITs. DBS, OCBC, and UOB essentially operate as the gatekeepers of fortress capital, with distributions anchored in SGD stability. For the heartland investor, the wallet consequence of chasing regional yield is neglecting these local yield generators that offer sanctuary during global rate shocks. Shifting capital out of a stable SGD environment to chase a nominal return across the causeway is essentially shorting the Singapore dollar, a forensic gamble that rarely pays off. There is a second-order effect here: the legislated floor versus dividend declaration models. The CPF 4% is a hard floor that has not moved in decades, providing a predictable benchmark. The EPF yield is a variable declaration based on annual performance. In a bad year, that number can shrink, whereas the CPF floor is a sovereign promise. The market currently prices a stability premium for the SGD that makes the 4% floor functionally superior to a volatile 6% elsewhere. A guarantee you can bank on is always worth more than a maybe you have to chase. The evidence clearly shows that the yield gap is a product of two entirely different mechanical designs, not a difference in management competence. The 10-year currency depreciation math reveals that the 6.30% advantage is a statistical illusion for any investor who eventually needs to spend their capital in Singapore dollars. When you strip away the emotion and look strictly at the numbers, the structural difference tells the entire story of where your money actually goes. You simply cannot compare a volatile equity engine with a sovereign-backed bond model and expect the risk profiles to match. Let us review the macro evidence dashboard. The EPF annual dividend of 6.30% is a variable, performance-linked figure, while the CPF 4% floor is a legislated sanctuary. Crucially, the EPF carries an equity allocation of roughly 42%, making it a high-risk engine design. Contrast that with the CPF's 0% equity exposure and bond-heavy security model. You are taking significantly more equity risk to achieve that regional headline yield, all while facing an SGD to MYR exchange rate that acts as the primary currency tax. The forensic linchpin of this entire audit is the 2.6% average annual depreciation of the ringgit against the Singapore dollar over the last 10 years, that compounds to a cumulative 29% currency loss over the decade. The arithmetic is straightforward. 6.30% minus a 2.6% currency drag leaves exactly 3.7% net return in SGD terms. That is lower than the guaranteed CPF floor, meaning more equity risk and more currency risk actually results in a lower net result in your home currency. We must acknowledge the current exchange rate trajectory. At 3.10 today, the ringgit has recovered from the 3.35 level we saw a year ago. That near-term recovery is absolutely real. But zoom out to the full decade. From 2.58 in 2014 to 3.10 today, we are still looking at a cumulative weakness of 20%. The forensic case requires accounting for the full decade of currency risk, not just the recent bounce. This brings us to the strategic picture, which is bifurcated between those seeking sanctuary in Singapore and those willing to accept corridor risk for nominal gains. The forensic verdict here is absolutely decisive. The Singapore fortress sectors remain the primary defensive play for heartland portfolios as regional currency volatility persists. We have to map out the potential trajectory so we are not caught off guard by sudden shifts in macroeconomic conditions or unexpected central bank moves. It is about building a portfolio that survives the storm rather than one that looks good only when the sun is shining on the exchange rate. In our base case scenario, a higher for longer rate environment combined with Singapore dollar strength means bank dividend stability and continued depreciation pressure on the ringgit. In a bear case trigger involving a regional recession or currency shock, we see a flight to fortress assets, which exposes the yield trap in high leverage REITs. Even in a bull case where a Federal Reserve pivot stabilizes the ringgit, the CPF floor simply becomes an ultra-attractive benchmark. The odds firmly favor the Singapore model regardless of which macro path the global economy decides to take. As an investor, you must run your portfolio through these forensic stress tests. First, the ICR test. If your largest REIT holding saw its interest coverage ratio drop below 3 times due to refinancing, would the distribution still clear your personal forensic floor? Second, the currency shift test. If the exchange rate moved 10%, how much yield survives the translation back to Singapore dollars? And finally, does your portfolio have a fortress core that can withstand an 18-month window of global equity volatility? The shock absorption audit for the Singapore heartland starts with the industrial REIT sector. An ESR REIT is our forensic case study. Its gearing stands at 48.2% against my 35% ceiling. More critically, its interest coverage ratio is at 2.99 times, breaching the 4 times floor. This is not a theoretical stress scenario. This is the current state of one of Singapore's largest industrial REITs. It is already in breach of both key forensic thresholds, showing exactly what happens when gearing drifts higher. The buffer has already been eliminated, leaving retail investors exposed. When we look at the shock absorption gap between a big 3 bank and a mid-tier REIT, the contrast is stark. DBS, OCBC, and UOB carry the structural benefit of higher for longer net interest margins and currency strength. Conversely, mid-tier industrial REITs with sub-3 times ICR have already run down their buffers. The forensic question is not whether they yield more than the CPF special account, but whether they can continue to pay anything at all if borrowing costs rise further. If you are aged 50 to 57 and still building your portfolio, Focus on engine design before the yield headline. The 6.30% EPF yield is attractive, but adding it might breach the 25% concentration rule in your total net worth if you are already equity heavy. The most efficient move available to a Singapore accumulator right now remains the CPF ordinary account to special account transfer. You lock in a 4% legislated sanctuary return with zero currency drag. If you are a drawdown investor aged 58 to 65, the sanctuary status of the Singapore dollar is your most important asset. All your expenses, from medical care to housing and food, are priced in SGD. Chasing a higher yield across the border introduces sequence of returns risk at the exact moment of drawdown. The retired 62-year-old who chose the CPF sanctuary a decade ago is not doing currency math today. The one who chased the EPF headline absolutely is, and they are likely regretting the decision as their purchasing power erodes. The difference between a true sanctuary and a yield trap is decided before the opening bell, not after the damage is done. When market alerts flash red and indices drop double digits, the structural vulnerabilities of your portfolio are instantly exposed. The red flags in high leverage assets were always there in the public filings for anyone willing to run the math. If you ignore the currency risk and the debt load to chase a headline yield, you become the exit liquidity when the market reprices. If you want to stop being the exit liquidity and start being the analyst, this is where Iggy's Elite Investors comes in. You get zero-day reports with the full forensic breakdown of these institutional cheat sheets before the market opens, allowing you to identify landmines disguised as opportunities. For less than the price of a kopi and kaya toast at Ruffles Place, which is about 9 Singapore dollars a month, you get access to the red zone watch list that flags gearing ratios and debt overhangs early. This is the structural advantage you need to navigate the market safely. The regional yield gap is not a failure of the Singaporean model. It is a feature of its fortress design. The 4% sanctuary floor provided by the CPF system is one of the most efficient risk-adjusted returns available to any retail investor in Asia. It achieves this precisely because it carries zero currency risk, zero equity volatility, and zero refinancing exposure. The storm is coming for the investors who forgot that in retirement, the only number that matters is your purchasing power. Let us condense this entire audit into 2 sentences. ESR REIT yields 9.0% and breaches both the gearing ceiling and the interest coverage ratio floor. The CPF special account yields 4.0% and has never missed a payment in its history. That is not a simple yield comparison. That is the entire forensic argument laid out in plain sight for anyone managing their own capital. You are choosing between a highly leveraged vehicle teetering on the edge and a sovereign guarantee that lets you sleep at night. The Causeway is not a yield opportunity, it is a currency risk you are choosing to accept. Make absolutely sure the math supports the choice before you cross it, because sacrificing the security of the Singapore dollar for a nominal percentage gain is a gamble your retirement cannot afford to lose. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get zero-day access, link in the description. The red flags were always there. You have a 7-day window to review the ESR REIT stress test breakdown and full sector data before this embargo lifts. Join Iggy's Elite Investors through the link in the description to protect your portfolio today. This content is produced for educational and informational purposes only. I am not a financial advisor, I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.